On this episode of Uncorrelated Minds, Kevin Kaylakie has a conversation with Addepar's head of portfolio and market analytics, Dan Golosovker. Addepar is a leading provider of technology and wealth management solutions for investment advisors and family offices. Dan is an industry veteran who previously worked at Bridgewater Associates. He recently developed the Investment Sentiment Index, a transactions-based index of ultra-high net worth investors. Utilizing Addepar's robust data platform, the Investment Sentiment Index provides purpose-built insights representing more than 10,000 investment portfolios, each valued at more than $10 million in total assets. So, Kevin, take it away.
Well, I thought I would start the podcast with the title of the podcast, which is The One Question We Are Always Asked by Our Clients. Rather than wait to give you that answer at the end of the podcast, I'm going to go ahead and give it to you now and let you know how our guest today is actually helps us answer that question even beyond the scope of our own client base. Dan, thanks for joining us. I'm happy you're here and you're able to join us on the podcast. And please go ahead and just give us a rundown on your background and how you ended up as the head of portfolio market analytics for Addepar.
That sounds great. Well, Kevin, thanks again for having me on your podcast. I'm really excited to be here. It's been kind of an interesting ride in my career. I've essentially had a couple of jobs throughout my entire career, and because of that, I've been able to go really, really deeply into those jobs. At Bridgewater Associates, we spent a lot of time learning about how markets work, really learning about sort of the connection between the different forces in the marketplace and what drives prices up and down across bonds, stocks, commodities, and other asset classes. And one of the deepest learnings from that front was in the area of flows, like who's literally buying and selling assets and in what degree. And that's, very much led me to kind of my next job here at Addepar, which is head of portfolio analytics, and leveraging the data set there to really study the flow of assets. To kind of answer the title of the podcast, what brought me to Addepar was very much the idea that we could really aggregate all of the portfolio transactional data and begin to look at how assets are flowing, particularly amongst high net worth investors.
Well, thanks, Dan, for giving us that background on your history, where you've been before and where you are now at Addepar. And I think a lot of the people on this podcast or listeners of the podcast may not know that we are an Addepar user. So we are a firm that uses Addepar. When we had initially reached out to you and your group to learn more about the Investor Sentiment Index, which is, again, taking it a step further. When people ask us the question, hey, Kevin, what are the other clients doing? We now have a resource with Addepar to say, well, even better than just what our small subset of clients are doing, what is the broader set of clients in this space doing? And really, today we're going to learn a little bit more about who is Addepar. I'm just going to give a little background on why I chose Addepar, and then I'll let you give some more of the technical definitions of who is Addepar and how do they manage data and things of that nature. Really, thanks again for joining us. When I started the firm, I spent about a year interviewing a number of different families, about 39 different families that had 30 million or more in investable assets, and really ask them to give me your top 4 pain points. So what are the 4 things that your current private bank, wealth manager, broker isn't doing, family office isn't doing, that really you would like to have done? And the number one most glaring problem that faced all of these family offices and ultra high net worth families was that they did not have someone or something, a resource that helped them have a complete view of their wealth as a family, regardless of where the assets were managed or by whom those assets were managed. In fact, 38 of the 39 families said that was the number one issue. It was, I don't have a way to put this all together and really understand the big picture. And just so we don't have additional questions on the podcast, the other 3 were, number 2 was I need help with my alternative, my direct and private investments, which is also a part of our relationship with Addepar. The 2 after that were, for the sake of the show, we'll make it advanced planning. So in other words, we're creating a trust for the family. How does that flow through from the estate plan and tax side? And then the last one is fees. And it wasn't so much that they thought they were paying too, well, let me say that. Most of them did think they were paying too much, but it was more so that they just didn't understand their fees. Addepar is unique in the sense that while it doesn't directly solve for all of these, there is a part of Addepar that helps us address all of those. And that was one of the reasons we really chose Addepar. But again, coming back to the number one issue, and then I'll actually add to that story. There was a friend of mine who was part of a large family business consulting group. And I went to visit him and I asked him those 4 questions, and he literally listed them off in the same order. So I knew at that point that I had to break off and start a firm that really addressed this. And I knew I needed a partner that was at the top of the stack when it came to family offices, and at the top of the stack when it came to managing alternative and direct and private investments. And so as I always say, I must have regenerative cells in my body, because I chopped off my left arm and went ahead and got Addepar as a startup, and very grateful I did, because the problems it solves and the solutions it creates are very, very top tier, and really what the clients were looking for at the end of the day. So give us a little bit a background. What is Addepar, and how does it benefit these clients and family offices we serve?
First off, we're very happy to be your technology partner, Kevin. The story that you just basically told really resonates with a lot of the clients that we serve. For the listeners, Addepar is a wealth management platform that specializes in data aggregation, analytics, and performance reporting. And it really helps provide advisors kind of a clear financial picture to make really timely, informed decisions. The way that sort of the story came about was that Joe Lonsdale, who also formerly started Palantir.
Now an Austin resident.
That's correct. During the financial crisis, for his own needs, he really wanted to be able to build a quick view into his overall financial picture. And every time he would ask that question, it was just really hard to get the answer back. And so I think he realized that even just kind of getting the basic stuff done right, just showing the entire picture and being able to look at it in any granular way is relatively hard. And so he basically set up Addepar to be able to first do that first thing, even before being able to do deep analysis and create tools that help you assess the portfolio, really just aggregating in real time the financial picture. The key features of Addepar are exactly that. The first and foremost is that we aggregate data across a lot of custodians all across the country on a daily basis so that we can create a consolidated financial picture across all of the accounts. It's also very good at modeling alternative assets. And for high net worth individuals, that is both an important and increasingly important set of asset classes that they want to invest in, and being able to have a very detailed view into that is necessary. The way this whole thing works is on a daily basis, all the custodians basically send us files with portfolio level information that is normalized into a common data model and then fed into the application so that you can see the aggregated picture of your investors and clients, be able to kind of work with them and really focus on the thing that is most important to you, which is making sure that their goals are really met, as opposed to kind of working through the mechanics of having to do those very, very, very basic things. I guess the only other salient point is that the reason I think this is a particularly unique data set in overall is that it's really a view, it really is portfolio data of the high net class. These are very important, sophisticated investors in the marketplace. Addepar now holds somewhere between 2.5 and 3 trillion in assets reported across the platform, and we work with 600 clients like yourself to basically help them with these services.
The function of Addepar that we have received has been phenomenal. In fact, when originally demoed the environment for one of the families that did eventually hire us, he said the same thing in a different way. He said, what I need, you know what I need, Kevin? I need the world's best one pager. I need to just log into one place and see it all in one screen and be able to see everything I have all the way down to, kids and grandkid trust and everything else that's in there. And I said, okay. And so when we built out the first environment for him, we ended up using it as our template moving forward. So when we do the net worth overview for the families, when they initially go in, all they see is the family net worth value, some key metrics and IR numbers and performance with it, and an asset allocation chart. And then they can just click. And then they see all of the family members or family units. And then they click. And then they see all of the accounts. And then they click. And then they see all of the asset classes. And then they click. And then they see all of the actual assets. And it goes all the way down in one screen from the entire rolled up net worth of the family office or family all the way down to the individual tax lot. And they can do that in one screen in one portal without going anywhere else and find all of their information. And of course, we've built out since then a number of additional views that go with that as families want want to see different things, charitable views, educational views, views of the trusts, retirement, and things of that nature. But the biggest one I would say was the alternative assets. I spent a considerable amount of time evaluating platforms that would be able to scale. Now, I don't have a lot of need for scale because we work with a smaller number of wealthier families, so it's not a huge scaling issue for us. But we also needed a way to present that data, not just to have the raw data. And Addepar did a really wonderful job building out the portal for us on that side. As we go back to the first question, it is throughout this process that you have helped develop the Investor Sentiment Index, which we described briefly at the beginning. Really, now that we understand the type of data and the type of investors that are in here, they tend to be more family office-like, even if they're not all straight out family offices. Someone asked me, what's the definition of a family office? And I said, that's a wonderful question. My definition is there actually a door to an office that I can walk through, then we'll call them a family office. If not, then they're just a wealthy individual. But what Addepar does allow us to do, and I want you to talk first here, if you could, just to the privacy and the data pledge that Addepar takes, because a lot of times when we talk about moving data or analyzing data on the system with very sensitive and well-known people, and they really want to understand how it's protected. So let's talk about that first. And then tell me, what is the ISI? How is it constructed? How does your group build it? And then really, what does it provide? What are families and advisors like myself getting out of this process?
Yeah, all very good questions. Just as a first point, I guess as Addepar started to amass very significant amounts of portfolio data, one of the realizations that we've had is that we can really leverage that information to benefit our clients and the investors. That information in an aggregated format can really give insight into how other investors, like the people that work with you, what are they actually doing with their portfolios on a regular basis. That all starts with the concept of security and privacy. Because although this information is very useful, it has to be done in a way that maintains the anonymity and privacy of all of the investors. And so what we do is we have effectively a data pledge and a data privacy policy that we've constructed that really just ensures that all those things happen. The way our data systems work is we aggregate and anonymize all of the portfolio information. We go even several steps further by ensuring that no particular investor or groups of investors are overrepresented in any of the analysis that we produce. We think that that's super important because at the end of the day, our relationship with our clients are just so, paramount, as are yours with the investors that you work with. We take that as a first line responsibility, and then everything else kind of falls out of that. That's why we've constructed this pledge and take that as the first step. From there, then the question becomes sort of what kind of analytics is going to be really, really interesting for you and for the investors that you work with. Where we ended up starting is with this concept of sentiment, investor sentiment. And the reason why we started there is because investor sentiment is one of those ideas that is super intuitive and super easy to understand. And by the same token, extraordinarily hard to measure.
Yes.
Right. So we have this kind of interesting problem. Investor sentiment is this concept that there are periods of time where investors feel like they can take on more risk and will move into either add more risk to their portfolio by moving out of cash into risky assets or move from low risk assets into higher risk assets. And there are periods of time when investors are kind of weary of risk. And so they're reducing the overall risk in their portfolio. And that's what kind of a sentiment gauge is really about. As we kind of started our research and looking into how sentiment gauges work, what we realized is that we actually have a competitive advantage in this space. And part of what we learned was if you go out into the marketplace, there's really two types of sentiment types of measures. One type of sentiment measure is more survey-based. So if you look at like the UBS sentiment survey.
Camden, yeah.
Exactly. Any one of those, they're going out to investors and asking them questions like, what are you going to do in the next month? Or what are you going to do over the next 3 months?
Yeah.
The challenge with that as you can kind of imagine, is people don't always do what they say they're going to do.
Exactly.
Think about sort of like political polling and how good that's been at predicting sort of outcomes. You begin to realize, well, yeah, there's probably some flaws in asking people what they're planning to do. The other approach is more of a kind of a market data type of approach. And the classic example would be something like looking at equity flows. And so you can look at equity flows reports and try to get a gauge as to, are people buying equities or selling equities?
Yeah, I often think about the put call ratio as well. Who's actually buying puts and buying calls and selling them?
Absolutely. So any of the volatility type of measures, you can look at option pricing. There's all sorts of gauges. When you're specifically sort of in the volatility markets, you can look at just pure volatility and whether that's if volatility is rising, maybe that's an indication of people getting worried about risk and vice versa. They also come with their own problems. And the major problem with those is that they're effectively giving you a measure that's kind of looking at the entire marketplace, all the participants in the marketplace. And so you have the hedge funds and you have your institutional money managers, you have your retail, you have your higher net worth investors. Everybody's kind of aggregated together. And that's kind of a problem, especially if what your real question is, I want to know what the other families are doing who are like me. That's what I want to know. I don't want to know what the hedge funds are doing. I want to know what family offices are doing. That's the problem of the market-based measures. Or the other kind of problem is that you can have individual players have an outsized kind of impact on the overall market. If you have a hedge fund who takes on a very large position or takes off a very large position, you can see large moves in the market, and that can get distorted, and it's very difficult to make sense of it. So people use a lot of statistics and other things, but that's still very hard to kind of read through the tea leaves.
One of the reasons that I was really attracted to the index and thought that we would be able to implement it somehow usefully in the practice for our clients is that, as I've always told my partners here, is we invest for people. We invest for humans who have emotions. In fact, what connected us kind of off in our own little world was the fact that we are a risk parity shop. And for those who know Bridgewater, Ray Dalio is the kind of father of this, really brought this to notoriety through the All Weather Fund. We really focus on risk for our clients. And we understand that clients, no matter how many questions we ask them ahead of time, that they will make changes when portfolios start going down. And so we create a portfolio structure that really balances those risks. I won't go into that today. If you want to touch on previous podcasts, we cover that in depth. But really, this index in and of itself helps us evaluate the longer term equity focused bucket for our families, the ones where they can afford to be risk on, risk off, not to use a hackneyed term, but they're looking at things like, hey, I want to get out. And it's like, okay, well, don't get out in the core portfolio because we know what the timing of that, the cash flows in there look like and where they need to be structured for you. But, if it's a longer term asset, 15 years plus down the road in terms of a time horizon, then they're really interested in this. And not to say that they market time, but to say that they market sway. So they don't have to be in the markets. They like to be in the markets at that level. When things are going well, they like to lean into it, and things are poorly, they like to lean out of it. And this was a way to actually use data. What are actual other human beings doing with their capital? Again, not institutional capital who are investing on a perpetual time horizon. That there's a really easy answer for that. But when you're dealing with not just the family, but the different members within the family, they even act differently amongst themselves. And we have to have tools. And more so, it's just, I think for us at the end of the day, what the ISI does is it just gives one more level of comfort to the families that we have our fingers on the pulse.
All very good points. I think what we're, ultimately what we're striving to do is really create that additional data point. You have all of the traditional kind of measures, and there's a lot of reports and other third-party research that you can tap into. And we really are striving to give that one additional data point that helps you kind of triangulate and helps have that quality conversation with the investors that you work with. And by construction, what we've tried to do with the investor sentiment index is make it oriented around the investor as opposed to oriented around the dollars, right? The investor sentiment index really is basically a very simple poll of who's adding equity risk in their portfolio minus sort of the percentage of portfolios that are subtracting equity risk in their portfolio. And it's very simple like that. So it's very much oriented doing a kind of taking almost a democratic poll of all of the investors and seeing what they're doing in aggregate. And again, all we're really doing is doing this simple calculation of the percentage of portfolios that are buying equities minus the percentage of portfolios that are subtracting equity risk. Because of that, you're kind of getting this very equally weighted, portfolio weighted view as opposed to a dollar weighted view. And so you can kind of get you can feel comfortable that you're actually getting a good view across all of this investor base. And the other thing that we've kind of really focused in on is just making sure that we're looking at fairly high net worth individuals. We set the cutoff at $10 million. That was a little bit arbitrary. People define high net worth in different ways, but what we try to do is basically say, let's look at fairly large portfolios of which there's more than 10,000. So that's 10,000 data points that we aggregate into this index. The index overall, it kind of gives you an overall number, which is it overall adding equity risk, but an overall subtracting equity risk. We've taken other steps to go a little bit more granular than that. So we're also doing analysis at the sector level, as well as the single stock level, so that you can begin to look deeper ways into the portfolio and start to have that quality conversation of like, well, you're interested to maybe make this move in your portfolio. Well, let me share with you what others like you are doing, and we can at least have a conversation about, to what degree do we think this is a good idea or not a good idea, right?
Yeah, and I would say too, that additional level, really at the sector level, as someone who follows the index, and every time it's released, I read it in its entirety and see what the input and output is from your group, is that it just proves the fact that you really cannot time the markets. What is these families are buying 1 month from a sector is very different from what they're buying the next, and then they're back on the next month after that. And so it's really all over the place and how it moves. There's some broader thematics to what's happening on how people are investing long term. But for those who want to try to time it on a monthly basis, you can just look at the output and say to yourself that has to be a fool's errand, unless you have some sort of inside knowledge, which we know is illegal. But, I was really fascinated to hear from you about the kind of March and April of 2020 data points. I always laugh, and through the bulk of my career, we always talked about the financial crisis, what happened in 2008. And now we're actually having conversations, well, what happened in March of 2020? And how did you guys do then? Like what was going on in the markets? I know that along with the meme stock craze that is going on right now, there's a couple of interesting data points that have popped out with your team, and we'd love to hear about those.
Interestingly enough, for me, I remember very clearly exactly what I was during the financial crisis and during March and April of last year. It was so clear in my head in terms of where we were and what we were working on at the time. So that totally resonates. I guess what the main learning that we have through this work in the Investor Sentiment Index is that investors in general are relatively contrarian in nature. And they're you can tell that they're relatively sophisticated investors who are not just going up and down with the market. They're doing something a lot more complicated than that. And you can kind of see that in a number of these data points. Like the example that you gave is that in March of last year, if you recall, as the epidemic was just kind of getting going and as information was coming out, we ended up going through a number of the market sold off quite a bit in three successive times during the month of March. And what was very interesting about that was that for each of those sell-offs, the investor sentiment actually turned very bullish during each successive sell-off. So in other words, the investors were seeing these as successive buying opportunities, completely in the opposite direction of the aggregate market. Whoever was doing all of the selling, it wasn't these sets of investors. This was clearly patient capital looking for opportunities to improve returns. Incidentally, this also happened in the month of May of this month. We had that short sell-off that ultimately recovered back in the month of May. But this was also one of those examples where the investors represented in the index took that as a buying opportunity, even though more broadly they've been bearish the market over the recent time frame.
Very cool. Well, I know also the ISI, the Investor Sentiment Index, is the tip of the iceberg. And there are some additional things that you are working on within Addepar. I'm not sure what you can share with us today and what is still needs to be kept under the cloak or under the vest. But please let us know what other types of benchmarking or what other data is coming out of this from your families that is really being sought after from you by your families, and then also really how are you planning to use that moving forward?
Without going into sort of like the specific deliverables and when they're all coming out, I can talk a little bit thematically about what we're hearing is interesting and the kinds of things that we're working on. I think it starts with basically the expansion of just sort of the transaction flows-based research, where we've used the ISI to really hone in on equities. I think that the next area is really kind of rounding that out with all of the other asset classes and getting a holistic view into where assets are flowing. In my view, I think the most interesting piece of that, and also we've heard this from many people, is particularly on the private asset side, both in terms of funds and where new commitments are going, but as well as direct private company purchases and sales of shares in private companies, in direct venture effectively, where that kind of money is moving. A lot of our research is going to be focused in around that. There's obviously some significant challenges that have to be overcome in order to do that, particularly on the private asset side, because in order to really figure that out, you have to do a lot of data quality work up front. And we're certainly, as a company, dedicated to doing that. But over time, that's something that we really feel we can add value to you and have a real competitive advantage, because I don't think there's anything like it in the marketplace at all. I think the other area that we're interested in is kind of more of the classic sort of benchmarking type of work, where looking at asset allocation and performance and kind of creating asset allocation benchmarks, performance benchmarks, being able to compare and contrast family offices and large portfolios and how they're allocated in different ways. We think that that's just kind of an important data set to have, and something that is worth looking at on a regular basis. And then finally, recently, ESG and impact have been something a lot of our clients have been talking about and asking us about. And we've started to think about how we could make an impact in this area. And again, kind of going back to the title of this podcast, I think one of the areas that we can help with the most is really helping clients see what ESG oriented portfolios, how they're structured and what's inside of them. And the reason why it is useful is because we're all still relatively new to ESG. It's something we're all learning about. We're all just beginning to incorporate some of those concepts into the way we put together portfolios. And it's just useful to be able to see what sort of best-in-class portfolios are beginning to do with their portfolios from an ESG standpoint. Those are the kind of three areas.
The ESG, we kind of stare at it right now ourselves and say the standards of evaluation are still kind of like the Wild West here. There's people making up their own rules and grid of how they evaluate things from an ESG standpoint, and some are laughable and some are really well thought out. We're really interested to see what Addepar comes up with in this area on that ESG front. And I think also on the benchmarking from that side is that I've been asked that question by a number of families and family offices here. Is the one question I received about a year and a half ago now, but was, hey, what does the average family office have in private real estate? It's a really good question. And so you can dig it up in some surveys, but again, they're survey related. And some people may say, oh yeah, we've got half of our portfolio in it. And in reality, they have about 17% because they are a real estate family and they want to be known as a real estate family, but they were smartly diversified from that standpoint. And it may not be the wrong answer. They just may not be looking at their assets in the entirety to give that survey answer. So you do have to take those with a grain of salt. Well, last question, Dan, we'll wrap up and let you go today. Enjoy some sunshine there in New York City. We know that for us, the one question our clients always ask us is, what are your other clients doing? And my question is, what is the most common question you were asked by your clients at Addepar?
Oh my goodness. So I think I'm asked exactly the same question. So we're all back to the very beginning. But absolutely, like that, it is the most asked question that I get from an analytics perspective. And clients are like genuinely interested in what others are doing. And that tends to be even more true when you're from the private asset perspective. Like that, there's some data, it's not great data, but there's some data that can tell you a little bit more about sort of the public assets, about equities and bonds and what's going on there, and you can build some form of a picture. But on the private asset side, it's really still in the very early stages of forming into kind of a robust industry. And so the opportunity there is really tremendous in helping clients get more informed through insightful analytics on how other investors like themselves are kind of working in private asset space.
Gotcha. Well, Dan, thank you so much for joining us today. We're honored to be partnered with Addepar on our technology side with their high levels of integrity, especially with client data and client privacy. That's a paramount to what we do in working with our families. And we really feel that even with this extraction of data, that you've really protected all of that for us and our clients and given valuable insights through your team and the work you do. Keep it up. I'm excited to see, especially what the private asset benchmarking looks like, hopefully here in the next few months.
Sounds great, Kevin. Thanks for having us. And again, we're delighted to be your technology partner and hope to talk to you soon.
Thanks, Dan.
Kevin Kaylakie and Dan Golosovker, thank you for an insightful discussion of Addepar and especially its investment sentiment index. You can contact Kevin Kaylakie at info@SineCeraCapital.com. Subscribe to the podcast to get the latest episode, and of course, share and comment. Thank you for listening to the Uncorrelated Minds podcast. Click the follow button below to be notified when new episodes become available. For more information on the topics covered in this podcast, please visit the show notes page for links to further information at www.SineCeraCapital.com. SineCera Capital, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where SineCera and its representatives are properly licensed or exempt from licensure. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.
The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for decisions based on such information, and it should not be relied on as such. Generally, among asset classes, stocks are more volatile than bonds or short-term instruments. Government bonds and corporate bonds have more moderate short-term price fluctuations than stocks, but provide lower potential long-term returns. U.S. Treasury bills maintain a stable value if held to maturity, but returns are generally only slightly above the inflation rate.